listening to the Real FI Podcast, where we discuss time-tested tricks, techniques, and strategies for pursuing financial independence today so that we can enjoy a better tomorrow. Financial independence isn't about getting rich quick. It's about cultivating a foundation to grow financially, mentally, physically, and spiritually. Let's figure out how to kick the 9 to 5. Here are your hosts, Patrick and James.
How's it going, everybody, and welcome back to the Real FI Podcast. I'm your host, Patrick McGrath, with my co-host, James Rippion. How's it going this evening, James?
I'm doing well, Patrick. I think we're going to have a great episode today. We got our friend Marco Bario here. He's going to be talking to us about what he's got going on in his investments, his unique strategies to building wealth. And needless to say, I'm excited. So let's just jump into it. So Marco, give us a little bit of background on your business and tell us, what you kind of have going on, all the balls that you got up in the air. Give us a little summary of what you're doing.
Sure, I'll back up a little bit how I got where I am. I live in Los Angeles. We were talking a little bit before we hit the record button. I moved out here a long time ago now, and I worked in the entertainment industry. So I've got about 25 years and working in film and television under my belt, I guess. But in 2015 or so, I was feeling I wanted to do something different, something more entrepreneurial, and I found myself going to some real estate meetups. And for those who've been to real estate meetups, or a lot of them are online now, right? But back in those days, they were still in person. Every week is a new topic. And 1 week I was going to flip houses, and 1 week I was going to buy apartment buildings, and 1 week I was going to be a lender. But right about that time, I thought I'd better find what's going to stick and what I can focus on. And as fate would have it, that month there was a panel of note investors. There were people who bought non-performing loans. There were people who did hard money loans. There were people who focused on seller finance loans, and it made a lot of sense for me. A lot started clicking. So that's how I started into that space. I started initially buying non-performing second position institutionally originated loans. So in that case, I was mostly looking at inventory that came out of the Great Recession, the 2008 period, and I was buying loans that probably hadn't had payments on them at that point for 5 or 6 or more years. And in most cases, the first were performing, but I would work with the borrower, hopefully on the second, to get that to perform, or in some cases we'd go through a foreclosure. I did that for a while, and then I started feeling I wanted to do something that put me more in touch with seller finance note holders. And the difference there is, in dealing with non-performing paper, I was dealing with attorneys and loan servicers all day, and I really couldn't talk to the borrowers. There's a lot of risk in doing that in that world. We can talk about that more if you want. But in the seller finance world, which is what I do now, I market directly to mom and pops who carried back seller finance notes. They sold a house. They often lived there for a number of years. They sold it and they carried back the paper, right? They did a seller carryback. And when they close that transaction, they no longer own property, but at that point they own paper. Just a different kind of asset that I think most people know can be bought or sold. The banks buy and sell them all the time, and the government does as well. But I'm buying those from individuals who, in most cases, have only created one loan their whole life. And I get to talk to people all over the country. I live in California. Ironically, I don't market in California. It's the only state I don't do business in. They want me to have a real estate broker's license, which I choose not to do. But I buy everywhere else. And I deal with the coolest people, the nicest people who share their life stories with me. And that's my full-time job. I do some other types of real estate investing on the side. And I'm going to be starting a new venture soon. But my focus is buying the seller finance paper.
So this is incredible. I know Patrick's salivating at the mouth right now to talk about this, because he He's on the other end of these transactions. He's the one engaging these sellers, finding and structuring the seller finance and carryback. So I'm curious because I know how Patrick does it. He's really good at finding these off-market deals, finding the sellers, and structuring these. How are you finding and marketing to these seller financed owners, and what kind of properties are you finding is just the typical deal for you? Is it multifamily? Is it single family? Is it commercial? How are you finding these people, and what's the typical property look like?
Mm-hmm. I work very much like people who do homeselling of real property work. I can send direct mail to people. Everything's recorded in the county record, right? So Patrick, if I sell you my house and we do a seller finance transaction, when we finish with the title company is going to record a mortgage or a deed of trust, depending on the state. And sometimes I deal with land contracts or contract for deed or instruments like that. But it's similar. Those instruments get recorded in the way that somebody, I don't do this, who sifts through public records can tell if it's an institutional loan, meaning it's Bank of America or Rocket Mortgage, versus it's a Patrick loan, is by looking at the name on the document, right? If it's an institutional, we don't want that. We go by that. If it's an individual, and again, I'm dealing mostly with mom and pop, so sometimes it'll be held in the name of an LLC or a trust. It's harder to track those people down, frankly, with direct mail. So, and often you'll find that those are professionals. But when it's, Bob and Sally Smith, that stands out in the public records as, oh, this is a seller carryback. So we know what this is. And that document also has a mailing address. So there are, again, just like people who go on PropStream or services like that and pull out databases and send direct mail. Those tools don't work exactly for seller carrybacks, but there are companies who spend time sifting through the public records and filtering out and finding the seller carryback. So those lists can be purchased and I can mail to them. And also I market online, again, just like maybe a wholesaler would market, sell mortgage note. And if you're in the right time and in the right place, you'll find an ad that leads you to me. Those are two ways. There are other ways to do it as well.
So that's super interesting. And I definitely want to dive more into this, but I do want to ask if you could explain to the listeners exactly what seller carryback means for those that, might not understand it, because there's all these terms: seller financing, seller carryback. Like, what does it mean? What's the difference, type of thing?
Sure, I can throw a few more terms at you to confuse you further. It's one of the harder things for people to understand, just because there's so many terms for it. But whether it's an owner carryback or a seller carryback, or it's owner financing or seller financing, or all the derivatives of that, let's go deeper into that example I started. So Patrick, I'm going to buy a house from you, and I come to you and we're negotiating directly. Could be a realtor involved or not, but let's leave the realtor out for this example. So we negotiate directly, and you say, and either I offer or you just offer to me that we could do a seller carryback. You're interested in seller financing, and actually, let me pause right there. There are a lot of reasons, Patrick, you're in the business of convincing people that seller financing might be in their best interest. Well, one of those in today's market is because there's been so much appreciation. So the reasons people seller finance is either the property is hard to get conventional financing on. The borrower is hard to qualify. Maybe they own their own business, or they just went through a divorce. Now, I don't recommend that people sell and carry back to bad borrowers, because nobody wants to get rid of a house they no longer want and replace that with a loan they really don't want, right? And there are ways to qualify borrowers, almost like qualifying a tenant for a rental, right? Credit scores and job histories and things like that. But the other reason I'm seeing more of today is just because there's been so much appreciation. So the problem is that if a seller sells a house they've held for a long time and they have a low basis, in other words, they bought it for $100,000 and now it's worth $500,000. If it's an investment property, or even if it's personal property, in some cases, they're going to pay a healthy amount of capital gains on that transaction. And the IRS is difficult as it can be to deal with the IRS. One thing they've done that's really nice is they have something called an installment sale. An installment sale is another term for seller financing. And what that means is that, so when Patrick and I do our transaction, I'm going to buy a property from him for $200,000, let's say, and I'm going to give him a down payment of $25,000, and then I'm going to finance. We're going to have an agreement between us, a promissory note, and I forget, is Maryland deed of trust or mortgage?
Deed of trust.
Deed of trust. We'll do a deed of trust and a promissory note. The promissory note it's an IOU. It's a fancier legal term for an IOU. It says $175,000 is our starting balance to be paid over the term of 15 years at 7% interest, and this is what the monthly payment will be. And here's what happens if the payments are late, and so on and so forth. Those are the terms that goes into that document. And then that document is secured by a deed of trust. The deed of trust makes it, puts a lien against the property, but it creates collateral. So if Patrick and I just casually say, hey, Patrick, can I borrow $10 from you? Sure, no problem. We've created essentially a verbal promissory note, but there's no collateral. Patrick can't repossess my car or my house or something if I don't pay him back the $10. But with a deed of trust in place, the lender, if you will, or the seller in this case in our transaction, has the rights to go after the property as collateral for the loan, so they can be paid back either through the borrower or through the property, the buyer or the property. So seller financing means there's no bank. Seller financing means there's just two parties involved, the buyer and the seller, and a trustee, but we won't get into that if there's a deed of trust. So we work it out between us. We work out the terms between us. It can be any number of years. It doesn't have to be 15 years, 30 years, 10 years. It could be 7.4 years. It could be anything we want. The monthly payment can be anything we want. Within certain limits, we can do any interest rate we want, and balloon payments. Again, there's some restrictions on that, thanks to some laws around something called Dodd-Frank. But we can do whatever we want. We can get as creative as we want. And what I really like about seller financing, and outside of us being investors on this call, is that it helps communities grow. Right? There are young people who can't otherwise qualify to buy their first home, who can when a couple, say, wants to finance them, wants to give them a break. There are people who are starting over who can go get a home for their, a single mom and their kids. These are the people I get to deal with, and this is why I like what I do. Do I make money at it? Yes. But I feel that by creating a marketplace for this seller carryback paper, it does a lot of good, I think, in communities and for the country. And there are no banks involved in these transactions. Remember how the banks have gotten us into trouble a few times. There are no banks in these transactions.
I think that explains exactly how seller carryback works. I know for me personally, I have actually been using seller carryback for the down payments, to fund the down payments and have the bank fund the rest. So that's even a little bit more creative in there. But tell us about why you're really going after these seller carryback notes and how you make money off of these. Like, how are you making money off buying these notes from mom and pop investors that might have, sold their house to someone on a 10, 20, 30 year note?
Sure. There's a secondary market for seller finance paper. Just like there's a secondary market for used cars, you can think of it as I buy used notes. And the cost, we saw this recently during the pandemic, the cost of used cars was very high over the last year or so. Ironically, the cost of notes was a little bit on the high side over the last year or so. And by that, I don't mean that the cost was just expensive. I mean that note holders were able to sell their notes for more money. And the reason for that was that interest rates were low. So let's go through a scenario. Somebody calls me and they've carried back a note and they've been collecting payments for some time, a year or two, or however long, or 5 years. It's all over the map, the people who call me. And they want to sell. Well, maybe they wrote the note at a 7% interest rate. And maybe there are another 12 years of payments remaining. There'd be a price for that from a note buyer like me, or some of the buyers I work with. I do operate a lot like wholesalers operate. So Patrick, I don't know, it sounds like you buy some properties for your own portfolio. I don't know a whole lot about your business, or James, yours, but I buy notes for my own portfolio, but I also wholesale some deals. So the other thing, of course, that people who market to homeowners do is they wholesale those deals. They get the deal under contract, and then they assign that contract to somebody who is ultimately going to close on the deal and fund it, and the wholesaler makes a fee. So I look at it this way. I generate fees to buy groceries and pay my mortgage, and I have a nice retirement account, a solo 401k in my place that holds a lot of seller finance real estate notes. And that'll be future for me. But I generate these fees ongoing to pay my bills. And that's my whole financial situation right there. And I know we're going to talk about financial independence at some point. I need to do some pivoting so that I get more passive income outside my retirement account. But we'll get there. So,
Okay.
so the way I make money on these is through fees, or just by buying notes and earning a yield. Now, hopefully, I strongly recommend this to everybody I talk to, that real estate investors understand the financial calculator. And these days, the financial calculator for some is an Excel worksheet. But I learned, and I still use every day, in fact, maybe I'm a little old school, HP 10B2 financial calculator, which there's an app for your phone. I think it costs $10, and there's the same app for Mac OS that I use, is the one I use pretty commonly. So somebody calls and we go through some numbers, and let's say there's a $50,000 balance remaining on their note, there's 7%, and there's the 12 years of payments. So those are 3 of the 4 important values on the financial calculator to calculate a yield. So I might say, well, I don't say this directly to the seller so much. I usually hang up and run numbers on my own, and I check out the property. I do an underwriting a lot like I was going to lend on a deal, just on buying existing paper. I want to know that the borrower's been paying. I want to look at their pay history. I want to look at the property and make sure there's enough value there to cover the loan, and then some with some equity protection. I want to know what kind of property it is. Sometimes notes are created against normal single-family residential properties, but it's also not uncommon to see notes created against mobile home and land, or just mobile home by themselves. I don't tend to buy just a mobile home. It's not actually real estate. It's chattel. It's personal property. But there are a lot of those notes out there. So single family homes are worth a little bit more as collateral than the mobile home and land. It's just easier to sell those if an investor ever had to take it back. So there's an underwriting and a pricing that puts the ultimate price that a buyer can pay in a range that usually lines up with what other buyers would price in that secondary market. I realize this is kind of a longer answer, but it's not so unlike why used cars were more over the last year. There was a shortage in supply, and there were a lot of people who needed them at that time. So in the note world, it's a little different because sometimes funds are cheaper. So sellers were able to sell notes for more money because the cost of funds for buyers was cheaper. Some of the buyers I wholesale to, were banks, and their cost of funds was incredibly low over the last several years. And they were able to pay good yields. Sometimes they were happy with a 6 or 7% yield on premium paper. But sometimes it's a kind of a beat up note from the bin of misfit notes, if you will. And they need 10 or 12 or 14% to justify the risk on that asset. So what happens is the note that's written at 7% gets discounted more significantly to raise the yield. And that goes back to why I encourage everybody to understand the financial calculator. because by adjusting the amount of money one pays for an investment, they can increase their ultimate yield.
Okay. So basically, let's say that $50,000 example. So that means that there is a $50,000 balance left on what is owed for the principal. You got 12 years left at that 7%. What would be typically what you would sell that note for, or what you would try to get for that note?
So a lot of note sellers call and say, well, what do you buy notes for? Well, it depends. It depends in the same way that, Patrick, if you called me and said, I have a Toyota to sell you, I might have a few more questions, right? Before I can tell you what I can pay for your Toyota, how many miles, what year, what model, what accessories, and so on and so forth, and what conditions it in. Notes are similar too. The borrower is really critical. We look at credit scores and we look at payment history. Those two things tell us a lot about a borrower. We look at more than the score. We'll actually look at the report, right? I can see if maybe they got into trouble at some point and dug themselves out. See a lot of medical debt, a lot of student loan debt, things like that that are tough right now for people. We usually order a BPO on the house. BPO is a broker's price opinion. It's a very high level appraisal. We don't go inside the house. The companies that we contract with usually contact local realtors that go out and snap a picture and look at some comps. They can be way off. But the pictures to me are the most valuable thing, honestly. I'll look at other sales over the last, these days, a shorter period, maybe 3 months, but it was going back a year or so at some point when the market was a little more predictable. And I make sure that their BPO price is within a range that makes sense, but I also look really closely at the photos. There's a blue tarp on the roof. There's a lot of junk in the front yard. Ooh, I kind of drove the neighborhood with the Google car and it doesn't look so pretty. These kind of things are factored in as well. So it's a long answer, but the more succinct way to answer it is I've paid anywhere from 50 cents to 95 cents on the dollar on the balance of a note. The 95 cents is going to be a note in Texas, because in Texas you can foreclose and get them out of the house in about 30 days, and that's a factor. A single family home in a good area with a borrower with great credit and great equity protection and some decent pay history. The 50 cents on the dollar is, believe it or not, sometimes there's notes written at 0% in the seller finance world. The collateral may not look so good. The borrower, the credit score might be on the lower side, so there's more risk there. So we want more discount, often just to give us more protection, investment to value versus loan to value, right? Or creating an investment to value.
So
yeah. So
like
basically, go ahead, James.
It's purely numbers, and I'm curious: is there ever a note that you cannot buy? And by that is the seller of the note, their opinion on the price aside. Are you always able to just make this work, considering the risk, as long as you're getting a good enough discount on the note?
If there are problems with title, that's an issue. I do, by the way, I didn't mention, but when I buy in my world, I'm closing through a title company, and I'm generally purchasing a new lender's title policy. Most people are familiar with an owner's policy when they purchase property, right? The owner's title policy ensures title and makes sure it doesn't guarantee that title's perfect. It just creates an insurance backstop in case there is a problem and somebody makes a claim against title. The insurance company will defend that homeowner, and if they lose that defense, then pay out the homeowner for their investment. It's similar for lenders. When institutional lenders write a loan, they get a lender's policy, and I do it as well. So it insures me. So title problems can be an issue. Collateral issues such as I don't buy, and most people don't buy, where there might be environmental risk. So if somebody approached me with a note on a property that used to be a gas station, those I don't know anybody who buys those. Or someone parked a lot of trucks and there might have been a lot of oil leaks or something. I don't know anybody who buys those. The borrower's credit can just be terrible. Maybe they declared bankruptcy recently. Maybe they had a recent foreclosure. Those are a pass. The condition of the collateral can be in something that nobody would ever want to put their hands on. I know when I buy for my own portfolio, I ask myself, would I be okay owning this house? Because there's always a chance you would own the house if things go south.
Okay. That makes a lot of sense. So basically you're buying you are offering the person who's selling their note a lump sum for you to then take over the note, and then you're assigning that for a fee to someone else who's going to ride that note schedule out to make their return. Is that kind of how that works? Sums it up a little bit?
Yes, the lump sum, and either I'm buying it for my own portfolio or I'm signing it out for the fee.
Okay. Yeah. So it's it's kind of like investing in a rental property, and you're going to make your returns with putting your tenants in there, but instead you are just owning the note on the property and you're getting your return based on that. You're not really having to deal with the tenants, the issues, all of that other stuff, unless the person gets behind on their mortgage.
Well said. Yeah. Have you ever called your bank because your toilet was clogged?
Nope.
No. So no, I don't get those calls. I don't get calls when the roof is leaky, but I am aware if they fall behind on their taxes, if they don't keep their insurance current, and if they fall behind on my payments, then I get interested.
Okay.
So we touched on this briefly. You had mentioned that Texas is a really good place for you to engage in this business because, don't normally have to do a high discount because it's easy to foreclose. What other states are out there that are either, really easy to operate this business in or otherwise just a headache and difficult to just based on how the laws are structured with foreclosure and things like that?
Sure. They're all over the map. New York is known as the worst. It's about 5 years, and it can cost $10,000 or more to foreclose in New York. California, believe it or not, is 120 days. It's not terrible. Texas is an outlier at 30 days. Now, there are a lot of bumps in the road that can change these timelines, of course. Borrowers sometimes will declare bankruptcy and then the brakes kind of get put on. Let's see, I'm foreclosing. I still have a couple of non-performing loans in my portfolio. So I'm foreclosing on a second in Maryland, where I know Patrick is and James used to be. And Maryland has my first foreclosure in Maryland. They have an arbitration period that we're in right now. Not arbitration, mediation. There's a mediator. State statute requires that we allow time for a mediator to get involved, and that process slows things down. So, see, I've got one in we're in Rhode Island right now that I've been in process on for about 3 years. They hired an attorney who's throwing everything at me. It's all over the map. It's all over the map. The best foreclosures are good underwriting, so you never have to go down that road. And it's pretty rare on the notes that I'm looking at. But again, I have a background buying non-performing paper, and I equate that to doing a house flip. Going into it, you know that, well, it's going to need, here's what I can see before we open the walls. But you know that there could be some surprises along the way. So there better be some reserve sitting there just in case.
Gotcha.
Totally understand. What's interesting to me, and I'm sure a lot of the people listening, have bought at least their first home. And, if you've purchased something in the last couple of years, most likely below like a 5% interest rate, you take a look at that when you're at the closing table and you see interest paid. And usually it's somewhere between 2/3 to 100% of the amount you're borrowing over the 30-year period. So you're almost doubling or your money basically. And in some of those higher seller finance deals that you're talking about, 7, 8, 9, 10%, something like that, I mean, you could be looking at 150% return on the principal amount. Is that what kind of what we're talking about here?
Yeah, yes. I also know I can't bank on it, of course, but I know that most loans pay off early. So that's where it gets really fun. And that's where the financial calculator is fun just to run scenarios on. Let's say I'm buying the 7% loan and I'm getting myself a 10% yield. So I bought it at a discount. It's 10% if they make the payments per the loan schedule to maturity. But if they pay off in a couple of years, my yield shoots way up. And that's because of the time value of money. Money now is worth more than money in the future. So if I invest $35,000, but I receive what the remaining balance may be in 2 years, might still be $45,000. That's a really good return on a annualized basis. That's a really good return. So while I dislike early payoffs because, oh geez, I got to go find another note, I love early payoffs because, man, the yield's really good. So I kind of get over it.
I was going to ask you what you prefer, whether you prefer the early payoff or not, because I feel like, at the time that you're stepping into these notes and taking ownership over them, the buyers probably, ideally had positive life situations, for themselves, and they're getting their credit up, maybe becoming a better borrower, and perhaps an opportunity to refinance. So I feel like you might almost be in a position to suggest to the borrower, like, hey, maybe you should consider refinancing and getting a lower rate. So that just goes back to my question, like, which do you prefer? Do you prefer to have them pay it off early, or to keep the note going?
I saw a pretty good number of early payoffs when the interest rates were low because borrowers had a lot of equity in their house and hopefully they got their credit score up, and interest rates were low, so they were incentivized to go borrow at a lower rate. Now, seller finance interest rates, I should say, are ideally higher than institutional rates. I tell people I get a lot of calls. I get some at 0%. I was getting a lot at 3% and 4% over the last several years, and they'd say, "Wow, you were really generous with that rate." Yeah, well, that's what the banks were offering at that time. And now I'm at a point I'm kind of building them up to understand that they're going to receive a discount. So I need to very gently explain to them why. Say, well, if you think about it, the banks don't lend their own money, and as we know, they get bailed out when things go south. I don't. You don't. So for that reason, you probably want to, not that you're planning on doing this again next week, but you probably want to get a higher interest rate. So these days, 7 to 10% would be more reasonable for seller finance paper.
I would be hurting. I'd be like, no way.
Well,
Personally, I'm always like, look, somebody's going to be getting this 5%. Why not you? Why not you getting that 5%? Like,
5% is less than inflation.
Hey, we're on both
Patrick
sides.
can work a good deal. He's a salesman. He knows how to.
I wouldn't want to negotiate with him. I can tell already.
Man, it's very interesting though, and trust me, when I was learning about seller financing and seller carryback, I always assumed that you were going to be paying a premium because the people that you were dealing with were seasoned investors that had a property with a lot of equity or that was paid off, and that they would garner or try to get a higher interest rate, a better return on their money. And that's what I assumed. But then when I started asking and, starting off at like 3%, 4% interest only, just throwing it out there, like people were taking it. And I was like, holy crap. Okay. This kind of works. Now, not everybody's going to do that, but it just so happened in the instances that I tried that, that's how it went down. So extremely interesting, but back to your thing, don't most homeowners only live in their home for 5 to 7 years? So are you projecting them to sell it sometime inside of that window already? You work that into your numbers?
I don't work it into my numbers. It I'm not sure how you guys run your numbers, you probably have more buy and hold rentals than me, but when I look at buy and hold rentals, I just look at cash flow personally, and any appreciation that I see is gravy, right? Great appreciation, wonderful. I can cash out refinance, or I can sell it someday at a profit. That's terrific. But I want to see what my income is going to be every month. I underwrite notes the same way. I want to know what my income is going to be every month, and if it pays off early, wonderful. But I have no control over that, right? I can't foreclose on them if they don't pay off early. I can't go after them if they pay off early. So that's just a nice surprise when it happens.
Interesting. So I know there's a ton of different types of notes out there, that you're buying, different classes, different, amounts. But what would you say would be a typical or an average return on a note that you're receiving on a monthly basis? Are we talking, $100 here, a couple $100 here? I mean, I know sometimes when I'm looking at my balances, my interest is, $1,100 and $300 to principal. You know what I mean? And now that's you. So what is like in your buy box? What are you looking for in that monthly, return on a note that you're putting your money out there for?
I never think of it in terms of dollars, although I do tend to avoid notes with lower monthly payments. I use a loan servicer to collect my payments, and they're say $20, give or take a month is their fee. So if the payment's only $250 a month and I'm giving 20 to the loan servicer, it does cut into my returns. I ran some interesting numbers on that recently. I won't go into it. If there's a long enough term on the loan, you can make some of that back. But that gets into kind of spreadsheet porn, I guess. So we won't go down that road.
So you're more of a cash on cash return kind of guy. Like you're looking for what that return number is over the dollar value, basically.
Yeah, yes, cash on cash, more so just an annualized yield for me, IRR. Because the time value of money is really important with promissory notes. The drawback to being a note investor is that the payments don't change. Very few instances where note payment changes over time. So I'm getting $1,000 a month, and I bought that payment for whatever I bought it for, $35,000. So in 35 months, I'm now cash positive. But those payments could go on for, I mentioned, 12 years. $1,000 could buy a lot more today than it's going to buy in 10 years. We know this. Whereas a buy and hold property investor can raise rents. So rents are a hedge against inflation, whereas notes, not so much.
Totally understand.
So,
Totally.
We've got a really good picture of like what your business is and how you're bringing in money, you're earning fees, you're putting some of these assets into your retirement account. But let's talk a little bit about what your goals are as far as, picking up these notes and what you're trying to do with your business. Like, what kind of metrics are you trying to hit moving forward with this note business?
Yeah, no, I knew you were going to ask this. And it's good timing for me because over the last 3 years, I built this note buying business into a real business, and it does well. I did really well over the last 18 months, especially. I've got my marketing figured out. I'm much better than I was when I started it, talking to note sellers. That's really important. It's the number one skill is talking to sellers. First making the phone to ring, but then actually having conversations with people. And I've done all this with my own capital. I'm not here saying I'm looking for investors, but there's a strategy with notes where when I buy a note, I don't have to buy the whole note. If there are 12 years of payments remaining, I can buy 5 years, or I can buy the 12 years and I can sell 5 years, 10 years, however many months of that I choose. That's called a partial. So think of a note as a pie. We just had Thanksgiving. It's pumpkin pie, and you can sell the whole pie, or you can sell it by the slice. So imagine, if you will, I bought a note at a 12% yield to me, right? I did the math and the numbers with the discount. It would have been a 12% yield. But then because I have a network of investors who like to buy notes and have retirement accounts, they're great in retirement accounts because they're not tax advantaged like owning property is with rent and depreciation and so forth. So I have an investor who's happy at 8%. So now I sell a partial of what I invested at an 8% yield. Now imagine, if you will, the 12% yield means my discount took my purchase price down to, I'm just making up numbers now, 65 cents on the dollar, 70 cents on the dollar, let's say. And now the 8% yield means that I'm now selling at something closer to 85 cents on the dollar. If I do it right, I can get most of my initial investment back and hold the back end of the note. It's called a partial. I can do this a lot better with some diagrams, but imagine I'm buying the whole thing and I'm selling a piece of it for almost what I paid for the whole thing, if not more sometimes. So I buy a full and I sell a partial. That to me that's my current wealth building path. I buy fulls and I sell partials. A partial, there's a big advantage of buying a partial. If I'm selling a partial of a first position mortgage, the partial buyer is actually in first position on the first. They're going to get their piece first. If there's an early payoff, they get their funds first. If we have to foreclose, they get their funds first. They have a much higher equity protection because they're in first position on the first. It's a first on a first. So they're in a safe position. They've got me with interest aligned behind them. So I'm experienced. I know how to handle non-performing loans. They may be newer investors. So they've got me backing them up. I want the loan to perform because I own the back end of it. So I'm going to make sure it does. In fact, usually what I'll do in my situation, I would just step in and buy it back from them if it goes non-performing and just take it over and sub it out maybe with another loan for my portfolio and take care of my investor. So that's not investors investing money in, Marco Bario Inc. That's people who I'm doing deals with who are helping me to recapitalize. So that's my wealth building strategy with notes.
That's extremely interesting. I had no idea that you could do partials. It's kind of like you're getting a partner, in the deal, but you're getting almost all of your capital back to go out and, buy more notes. So, let's say we have some people that are listening and, they're interested in investing in notes. What would you say, like, the first 2 or 3 things would be that they need to become versed in to be able to start in investing in notes as a strategy, and how to go about that?
It's an amazing community. The whole real estate investing community is incredible. And there's so many open people and so many groups you can join and ask questions, and it's supportive. And that's how I learned it. Combined with some educational programs, I assume there'll be a way I can share my contact information. I don't sell anything other than partials. I sell you a partial, but I don't sell education. I don't have an ebook or anything like that. But I do publish a weekly email newsletter all about seller financing. It's buying with seller financing, investing in seller finance notes. That's a resource. It's free. I just do it because I like to build a community and I like to give back as people supported me. And I really mean that. I don't sell anything through that. And I also, if people want to email me, I have an Evernote document that I can share through a URL. It's a whole list of resources for newer note investors, podcasts that are good, books that are good, educational programs that are good that aren't like ripoffs. There's some, overpriced gurus like there are in every area who I don't recommend.
Exactly.
I still pay money for some ongoing education, and it's such a great value.
Yeah, no, totally understand. I'm just thinking, for people out there that are interested, because the beautiful part about real estate, and that's what we try to bring, each week, is all the different aspects. Maybe someone doesn't want to own a rental property. Maybe someone doesn't want to flip houses. Maybe owning an apartment complex or, mobile home park or whatever doesn't get their juices flowing, but, it sounds like note investing is kind of that true version of that mailbox money, where you are just collecting a check every month off of, your investment. You may not be getting, hitting home runs out there, all the time. But if you're looking for solid, returns over a long period of time, which I know some people, that's their investment strategy, depending on where they are in life. It sounds like that would be really great.
Well said. Well said. I agree.
So
Awesome. So
tell us a
go ahead,
little bit
James.
about like your motivation. Like what actually, motivated you to get into this this actual field, and like what's motivating you to move forward and keeping to grow your business?
Initially, it was security. I had a career in the film and television industry. I really had two different careers in that world. First, I worked freelance on television shows. No, no job security whatsoever, right? So I've worked on a lot of television shows that I guarantee your listeners haven't heard of, because they just don't stick around that long, more often than not. So they pay, and I met people, and I was in with groups of people who continue to work, and I would continue to work with them, and that was nice. It's really hard to develop financial discipline, really hard in that world, when I would make a lot of money for 6 months and then no money for 2 or 3 months. And oh my gosh. And then I switched gears, and I did have a kind of a staff job. It was comical, really. I sat down with the human resources person who was signing me up for benefits. I'm like, excuse me, what benefit? What's I don't know how to sign up for a retirement plan. I've never had that before. So that was almost its own education. But I never felt secure in that world, because we were what ultimately turned into be a shrinking industry. I worked in post-production. We provided finishing services for film and television product, right? So we were finishing TV shows and movies and preparing them for exhibition and distribution and so forth. It's a shrinking world, and ultimately what led to me leaving that business. But so I wanted security, I wanted my own thing, and I wanted something where if I get hit by the bus and it doesn't kill me, but I'm severely compromised, that something will continue to pay me. So that really was a motivation for me, not to make it doom and gloom, but that's the truth behind it. Now that I feel that that's going to be there for me, I'm interested in time. I don't want to have to report to my desk every day. I already have something I can do from anywhere. I've done deals all over the place with just me and my computer and my cell phone. It's really incredible, and I want more of that, please.
So, it's always great hearing people describe the business that they built. And I went from the desk job to kind of own it yourself, build it yourself, run it yourself kind of business. Truth be told, like it's me, like I don't have any employees, but describe like your business day. Like what does your day look like in your business? Are you working 5 days a week? Are you working a full day without your typical 9 to 5 hours, or is it like a little bit more flexible?
I work my butt off. I always have, and I'm just getting to the point that I'm realizing how important it is that I don't do that forever. So this note business, and I don't know if anybody's ever done this before, but I'm building this to sell it someday. So in 3 to 5 years, there's no reason. I have a lead generation pipeline. I have a closing procedures. I have buyers in place, so forth. I don't see a reason somebody wouldn't write a nice check to take that over, and I'll stay on and I'll consult and I'll teach them how to run it. In the meantime, I'm initially I was influenced. There's a man named John Schaub who wrote a book, Building Wealth One House at a Time. If you haven't read it, I highly recommend it. So although I'm a note investor, I've always had one eye towards owning rental properties, because I believe that 10 free and clear rental properties would be what I need for the rest of my life. And it goes back to that security thing. And I believe managed properly, and I believe I have a way to do that, it's not going to be that big of a pain in the butt. In fact, I'll give people a monthly discount not to call me. I'm going to hire adults, and they're going to figure it out. And they can call my people, and they'll call me if it needs approval or something beyond that. So I think there's a way to manage property better than maybe some people do. I know there is, and I've learned from someone in particular who does it really well. So I'll be shifting gears over the next 5 years. I'm launching a new business. It's my rental houses will be in Maryland, and I live in California. And I have a way to launch that that's maybe a little different than some people have done it. So my typical workday is really busy. I kind of have working hours where I'm on the phone with people. When leads come in, I find I really need to be there to answer the phone. Otherwise, they'll call my competitors. It's a competitive business. So part of scaling is going to be bringing someone to hand some things off to. I'm terrible at that right now. Absolutely terrible at it. I don't want to let anything go. I admit it.
Same here.
Yeah, man, it's a killer. It was different when I worked for a big organization and I worked on shows because I came into an existing infrastructure. But now that I built it, it's my baby and I don't want to let it go. So 2023 goals right there, by the way.
There you go.
Yeah. So I guess I'll be working hard for a few more years, and then I hope not as hard.
Totally understand. Before we get into this next part of the show, I really wanted to ask if you wouldn't mind enlightening us just a little bit on what that other business venture is going to be. Yeah.
So I know Patrick, and I met Patrick at a real estate meetup in Frederick, Maryland. Weird place for a guy from Los Angeles to be hanging out.
Exactly.
I grew up in Silver Spring, Maryland, and I'm homesick. I've been away for a long time. I love California. My kids are here, but my youngest will graduate high school in the spring, and it's going to give me some flexibility. So I've back to not Peter Fortunato. I'm going to go see him teach this weekend, but John Schaub and his book, Building Wealth One House at a Time. I've always envisioned myself investing in a community where I live. And I don't do that now. I don't have any investments in California whatsoever. So I believe the Frederick area, Frederick County in particular, is interesting right now because of this new economy we're in. It's 45 minutes from Washington, D.C. It's 45 minutes from Baltimore. The schools are overall very good. Houses have gotten expensive, but not as expensive as some surrounding areas. And there's a nice sense of community there. And downtown Frederick, by the way, is great. So what I'll be doing is starting to build a rental portfolio where I don't own the houses. There's a man, if you ever have a chance to take his courses, do it, because he's probably going to not teach them much longer. His name's David Tilney. And he teaches about master leasing, which makes a lot of sense to me. It's these days in the short-term rental world, people refer to as arbitrage. It's a similar thing. So essentially, I rent from a homeowner with the right to sublease to a tenant. So I become the landlord and I control the property. Leases are powerful. Once you control the property, you can do a lot. So initially, I'm building the portfolio just with leases. But over time, and I published my newsletter. In fact, I wrote an article about it that came out in the Sunday issue. What happens is, because I control the property with the lease, when the homeowner wants to sell, and I've got a long-term lease, let's say 3, 5 or more years, they have to go through me because they're probably going to want to deliver it unencumbered by my lease to an owner occupant, right? So they have to come through me. So I'm in a perfect position to say, well, you're already used to getting monthly payments from me. How would you like to continue receiving monthly payments from me? Would you just want, what if I buy the house? You don't need to clean it up. You don't need to market it. You don't need to do any of that stuff. I've already got the keys to it, in fact. We close, we do title, and I'll continue to make payments to you, but it'll be an owner financed situation.
That's an extremely interesting strategy, and I really like that. When I tried to purchase my fourplex that I have now, that was actually one of the strategies that I tried to go after first, was hey, how about I don't have the money to buy it right now, but how about I sign a master lease for all 4 units? Then I can go in and start increasing the rents and everything else over X period of time. That cash flow will help me get my down payment and will also increase the value of the property. So when I go to get the loan, it makes it easier. And yeah, that was actually one of the things that I tried to do on one of my first deals. Always just be creative. And I think that's an extremely, you hear now a lot of people arbitraging for Airbnbs, but I like this strategy of arbitraging to, get to those 10 properties with the least amount of money out of pocket. You're not putting up 15-20% down payments. Really, you're signing, a couple year lease for, $1,500, $2,000 a month or whatever it is. And because you're getting a longer lease, you're hopefully getting a discount on that monthly. So that's that's a really, really unique strategy. I love it. But let's get into, what are some of the obstacles you see yourself facing with that, with trying to do that strategy and trying to build up your note business to sell it?
Time is a killer. I logged a few hours on Thanksgiving, which was just a few days ago from when we're recording this. I really do need to hand things off, so that's the obstacle, and build more systems. I have a partner who lives in the Frederick area, so that'll be helpful, and I'll be going back and forth every month or so. I'll probably spend a week there, starting in January, and I'll be back there next week for a couple of days. But I have a background in producing television and overseeing post-production on large feature films, large budgets, lots of people, lots of systems, lots of schedules. For a guy who thought I had no transferable skills, it turns out I really do. I'll get out of my own way here pretty soon, and I'll start putting a little bit more of that in place.
Love it. Love it. Well, that's a perfect segue into our next portion of the show that we like to call the Big Four. James, take it away.
Let's do it. So, Marco, give us something that you do that feels like a financial independence cheat code, something that is a hack that really puts your financial picture into place.
It took me a while to get there, and I mentioned this earlier in the call. Being comfortable talking to sellers. I was terrified talking to sellers when I started. But now it's just a conversation. And the trick there is I started becoming less attached to the outcome of the conversation. It's just a conversation. If we do business, great. If not, that's okay too. And the weird thing that happened is I started doing more deals when I had that attitude.
That is such a great piece of advice. And that's also a huge piece of sales advice too, is that, and people say it all the time, they can smell that desperation. They can hear it in your voice. They can see that you're trying to push an outcome out there. And when the main goal of the conversation is to see if you can help people, they feel that more than, they hear that you're trying to make money off of them, by closing this transaction or whatever. So I think that's a huge thing. And I bet you it came from just the more reps that you did, the more sellers you talk to, the more comfortable you got. Everybody's fumbling and bumbling on the phone the first couple calls they get, until they get off the phone and they're like, man, I really jacked that one up. Like, and then they get a little better. So that's an awesome piece of advice right there. So we like to call this next one resources. And I know we're going to get your email address for that, but for everyone that's listening right now, are there any books, podcasts, or people that you would recommend right off the top of your head that you think our listeners should go check out, that they would benefit from looking into?
Oh, absolutely. Absolutely. John Schaub, who I mentioned already. Peter Fortunato, who I'm flying to Tampa this week to go attend his paper course Saturday and Sunday. Vina Jones Cox has been doing Great stuff. I'm a member of one of her RIAs in Ohio, just so I have access to her education. It's wonderful. And the groups. David Tilney, I mentioned, teaches master leasing and landlording. Bill Cook, Bill Tan, Gary Johnston, Mike Cantu. There's so many.
I love it. Love it. Love it. Love it. Love it. Any particular podcast you've been listening to about note investing and this kind of investing?
I bounce around. Chris Sevigny, he had a podcast called the Good Deeds Note Investing Podcast, but he's recently changed that up. It has a new name. I can't remember. I think it's Creating Wealth Simplified. He's Chris Sevigny, Seveney. He also runs a Facebook page. He just launched a new fund and he's raising $75 million. So his and hired a bunch of people. So his business has shifted a little bit in the last 6 months.
Well, perfect. Well, we know people that are listening to our podcast, love checking out other podcasts too. So had to ask that real quick. James, question 3.
Speaking of big money, we call this one the future you. So Marco, paint a picture for us, 5 years in the future. Where's your personal life at? Where is your business at? You did a really good job earlier in the episode kind of outlining, what your 3 to 5 year plan path is, but just summarize that for us and put us in the future and tell us what you're doing in 5 years.
Yep. When I started, I invested just because I wanted to get some deals under my belt. And now my shift is, there's a plan. I'm stricter and more strategic in how I invest and why I invest. And I did share earlier, there's this procedure with partials. Now there's going to be a procedure with and a buy box, if you will, or an investment box around buy and hold rentals. To me, the answer is holding the back end on a lot of partials that'll start to pour out of my retirement account over time. And monthly income from rental properties that at first I control and then eventually I own, and someday I pay those off, and we'll reach a point where my kids will be really happy they're related to me. They say they are now, but maybe a few income properties that
even more so. A couple properties always helps.
Yes,
love it. Love it. All right. So for everyone out there that wants to get in touch with you, wants to get on that newsletter, would love that document that's got all of these amazing people's books, courses, all of that good stuff. What's the best way for our listeners to reach out and get in touch with you?
I know I sound so old school, but I'm going to give you my phone number. I like talking on the phone. I think it's how business is done successfully. So I'll give you other information too. But my phone number is 818-330-1100, 818-330-1100. That's Pacific time zone. And my company is Porch Swing Funding. So like a swing on a front porch with money on the back end, Porch Swing Funding. There's a website at that address. You can email me, Marco, at Porch Swing Funding, MARCO. Under the resources tab on the website, you'll see the sign up for the newsletter. It comes every Sunday.
Every Sunday. Well, I know I'm going to be joining it. I don't know about you, James, because I love all of the different aspects of seller financing, notes, all of this. It has been extremely helpful. I know I'm now a little clear on how it all works. And I'm sure there's a lot of other people listening too. If you like this podcast, if you hated this podcast, do something. Give us a thumbs up. Give us a thumbs down. Leave us a review. Send us a message on Instagram and tell us that we're bringing awesome guests each week. We're changing it up. And we'll talk to you next time. See you guys.
See you guys.
Thank you for listening to the Real FI podcast, where you learn from the investors that have lived the hard lessons for you. To connect with us during your pursuit of financial independence, be sure to join our community by following us on Instagram or emailing us at info@therealfi.com. If this content made you financially, mentally, physically, or spiritually richer, please make sure to leave us a positive review on your preferred content platform. Cheers to kicking the 9 to 5.